Business accounting, it's a fundamental aspect of managing and understanding the financial health of your company. And we do this through recording, organizing, and analyzing and interpreting financial data. And in that, we're able to do some performance tracking. We can make good decisions, and we can stay within the legal requirements that there are. And I had pressed earlier that the important thing here on the end, there is legal requirements that the buck stops at the owner. So it doesn't matter how good your bookkeeper is or what your bookkeeper messes up or your accountant messes up. It ultimately comes down to you. I have been in an IRS audit before. It was a nightmare. But fortunately, we are really good at doing our accounting. Thank you to Debbie, my wife, and then my experience and knowledge as well. Combine those with a good team, and we posted things where it needed to be posted. We managed our accounting system very well. Unfortunately for us, we had a little situation where we had just changed software. And we kind of lost we lost the detail of the data prior to that period. And that was, of course, the period that they were auditing was the period that we didn't have the detail of. So that was a lot of fun. Having good accounting records and doing good business accounting is going to help you make better decisions, and it's going to help you to monitor performance of your initiatives that you create and of the company as a whole.
Real quick. I don't
Yeah.
know if you're going to go through it or not, but the legal requirements and IRS auditing and all that stuff, that is not anything that I have knowledge of. So if you're not going to go through it, but you have any kind of link or video or just information to say, hey, this is a good way to understand what the IRS is going to look for to make sure I'm dotting I's and crossing T's with all that stuff.
Great. I'll make a note of that. I don't have anything off the top of my head, but I certainly will make a note of it. And as I find my pen, there it is, and see if I can find something for you. It'd be great. So really, what you have to really follow is general accounting, standard general accounting practices. So this is all kind of part of that, but yeah, I'll see if I can find something that kind of gives you a short version of that. So there's really two types of accounting that we do in business. We either do a cash accounting or accrual accounting. Most of this discussion is going to be based on accrual, almost all of it, because sorry, it's the best way. See there, that's where a accountant might argue with me, but accrual accounting is the way to go, and this is why. Cash accounting and accrual accounting are two different methods. They used in financial accounting to record and report the company's financial transactions. The main difference between cash accounting and accrual lies in the timing of which the revenues and expenses are recognized. Let me explain a little further. In cash accounting, it's a straightforward method where transactions are recorded based on the actual inflow and outflow of cash. Under this method, the revenue is recognized when the cash is received, not when it's billed, but when it's received. Expenses are recognized when they're paid, not when you get the bill, but when you pay, not when the expense is incurred, but when you actually pay that bill. It focuses on the immediate cash impact of the transaction and doesn't consider things like credit card sales or purchases. So cash accounting works if you run pretty much a cash business. You do the work, they hand you the cash, and you buy the materials. It's still timing can be off. But when you go to accrual accounting is more complex, but it focuses on recognizing the revenue when it's earned and the expenses when they are incurred, regardless of the timing of the inflows or outflows of cash. If you have an accounts payables and accounts receivable, you really almost must be on an accrual accounting method. It matches the revenues and related expenses in the same accounting period to provide more accurate depiction of the company's financials. Let me give you an example. You do work on May 25th. You bill a customer, and he pays you hopefully June 5th. All right. Now, if you're doing cash, that June 5th, that's if you're doing a cash method, you're not going to recognize any income or even doing that work. That work did not exist until that payment was made on June 5th. If it's accrual, then it's going to go into your May financials, not into your June financials, as far as your income statement. So these are two very different methods. Mike, are you on accrual? I think you are, aren't you? Or are you on cash? Do you know? You may not know.
I do accrual for reporting, but cash for accounting.
Okay. All right. So there are some advantages, end of year advantages of cash accounting. Basically, you just try to annihilate all your cash. So there is some advantage to cash accounting near the end of the year. But remember accrual, because you're, as you said, you're doing your reporting under the accrual method, which is good because.
Greg, can you hear me?
Yeah. Uh-huh.
Can you let Taylor in? He's in the lobby.
Oh, okay. Oh, there he is now. Okay. I was just watching for that. All right. So moving on. So we have cash and accrual. We're going to talk about accrual accounting, which again matches the revenues and related expenses in the same accounting period to provide a more accurate depiction of the company's financial performance. So let's talk a little bit about financial statements. Financial statements are key reports that provide an overview of the company's financial position and performance. The three main types of financial statements are the income statement, which is also called the P&L. And this summarizes the revenues, expenses, and net income and loss over a specific period, such as a month or quarter or year. So remember, so two things is it's about expenses and income, and it's for a period of time. Next is the balance sheet. Now, the balance sheet represents a snapshot, an in-the-moment snapshot of the company's liabilities, shareholders' equity, and at a specific point in time, typically at the end of a reporting period. Now, we're going to show another one here. The other statement is called a cash flow statement. Sorry, there you go. Cash flow statement. And a cash flow statement tracks the cash inflows and outflows of a company during a specific period, showing the sources and uses of the cash. Now, so these are the three primary statements that we use, especially in accrual method accounting. Now, you notice the cash flow statement. Remember, I said that the cash process or the cash accounting process is good because you focus more on how much cash you have and how much is going out and how much is coming in. Well, this because you have a cash flow statement in accrual method, that actually kind of covers for that side of it. So now you get the good reporting, the proper, more accurate reporting, and you get the cash flow as well. There's the balance sheet and then the income statement. We're going to focus on the P&L or the income statement today. The balance sheet is really a whole different animal. We're going to talk about some of the accounts that go to the balance sheet, but that's a different animal. And then cash flow, we can talk about that later as well. So let's start the chart of accounts. Let's talk about the chart of accounts. It's a structure or a list of all the accounts. So all those three statements, their skeletal structure is the chart of accounts. So it lists all the accounts used in the company's financial system. It serves as a foundational tool for organizing and classifying financial transactions. The basics of a chart of accounts for a business include these things that I'm going to show you. First of all, there is the account type. Okay, so every account, so you have these accounts, that's where you post all your numbers, your income, your expenses, all these things go to these accounts, and they all have they're a type, and then there is a number, and there is a name, and I'm going to share how that's structured. So first of all, accounting type. So we have one type is an asset, one is a liability, one is a revenue, and one is expense, and the other is equity. The last is this other income and expense. So the structure of your accounting chart of accounts will really have these elements in it. An asset is something that has value that the company owns, and we'll talk about what those are. As a matter of fact, I'll just move on to that. So the name, Every chart of accounts account will have a name. It might be an asset, includes cash, accounts receivable, inventory, equipment, something that carries value for the company. If it's a liability, then it is like accounts payables, credit cards. It could be loans. It could be even accrued taxes. If you have to pay sales tax or employment tax, some people will put that in their liability side at a certain period of time. So again, you have a liability is something that's owed. So asset is something you own. A liability is something that's owed. Then you have revenue. Of course, revenue, as we're describing it here, is really a sales or commission, something that has to do with the operations of your business, with what the product you're selling or the service you're selling. Because if it's another type of income, see, you notice it doesn't say income, it says revenue. So if it's another type of income, let's say investment income, you're going to see that down at the bottom as we move down. So expense, well, it's cost of goods. So there's two types of expenses, two main types of expenses. You have your cost of goods. We're going to go over that in just a moment. And you have your operating expenses. And your cost of goods has to do with, and we'll again describe it in a moment, but it has to do with anything that is incurred due to the sale of a product or a service. And there's a little bit of a gray line there. Again, we'll come back to that in a moment. And then you have your operating expenses, like your payroll and your rent and so forth. There's equity. We're not going to talk about equity today because equity is a balance sheet thing. But equity is stock distribution, retained earnings within the organization. And then there's the other income and expenses. And these can be investment or asset related, where you sold something or you earned income off of an investment, or you sold an asset and you lost money, or you sold an asset and you gained money. That's where those go. You obviously don't want to taint your revenue. Let's say you sell I'm just going to say you sold some high value asset that you were using, like a piece of machinery, like a dozer or something. You sell it and you make money on it. You don't want to put that in your revenue because it has nothing to do with your revenue. So it goes down in this line so that you can see it later. Now we're going to talk about the numbers. Now the numbers are really important here. So assets always have, I'm going to use the word always, but who knows? Different people might, different strokes for different folks, but normally assets are under the 1,000 accounts. So you have all your accounts are numbered. Every account has a number by it. And if so, your 1,000 accounts, that is your assets. Now you'll notice it says 1,000-XX. I'll explain those in a moment as to why I have a -XX there. Liability are the 2,000s. That's the 2,000s on your chart of accounts. So your 1,000s are assets, your 2,000s are liabilities. Your revenue is 4,000. Okay, so that's the numeric value, or that's the numeric identifier of your revenue. Now expenses. Remember, I told you there's two types of expenses. There is cost of goods, and there is your operating expenses. And so cost of goods is a 5,000. And your general or operating expenses. We also call those general administrative expenses. There's several names for them. Overhead, all those words are used for the same thing, but operating expense are 6,000. Your equity is 3,000, and your other income and expenses both can be in the 7,000, or sometimes we'll use even 8,000. So, Mike, looking at this, is there anything any questions, any thoughts before I move on?
This, I get most of this. There's these little loose ends that I'm not 100% sure of. So like I have a Bobcat, which is an asset, but I also have a loan, which I pay on, but I also use it for projects. So it never shows up, like the payment never shows up in a P&L report.
Yes.
It's all balance sheet stuff, but there are, so that's where like most of it seems pretty black and white, but when I get into something like that, that's when it gets a little bit gray. Yeah.
So we'll talk about depreciation a little bit, and depreciation does show up on your income statement, on your P&L, and that's where you're expensing that equipment over time. So we'll talk about that. So now there's also maintenance of that equipment, but depreciation is where a piece of equipment like that comes into play. We'll chat about depreciation in a minute. Okay, great.
Also your interest.
What's that?
Your interest.
Yes, your interest expense as well. Will go on your P&L if you for your loan. I forgot you had a loan on it. So when we look at that same chart, we see that there is the balance sheet accounts. These accounts represent the company's assets, liabilities, equity. Examples include cash, accounts payable, accounts receivables, notes payables, retained earnings, and so forth. On the income side, on the income statement side, those are the ones in green here. These accounts capture the revenue, the expenses, the gains and losses associated with the company's operations. Examples would be sales revenues. You can see there your cost of goods, your rent expense, your advertising, all those things that we talked about earlier. So what we're going to focus on are the 4,000, 5,000, and 7,000, and I'm sorry, 4,000, 5,000, 6,000, and 7,000 accounts, okay? Because those are income related. These others only fall on the balance sheet statement. Now, a cash flow statement, by the way, kind of incorporates both balance sheet accounts and income accounts, or income statement accounts. All right, so the basic components of a profit and loss statement or income statement is as follows. You have the sales revenue. This section shows the total amount of revenue generated by the company for the sale of goods or services during a specific period. Now you'll see here, again, it's a 4,000 account, and usually it's sales or commission of some point that you're receiving, not commissions that you're paying, but commissions that you're receiving. All right, then you have cost of goods. So your cost of goods represents the direct cost associated with producing or delivering the goods or service sold by the company. It includes expenses such as raw materials, direct labor, and manufacturing overhead directly attributed to the production process. Now this one gets a little gray, and I'll let me first show you. It can be purchases, manufacturing. It's 5,000. So what you put, we'll show you in a moment why I call it above the line. What you put above the line, oftentimes is a little gray. I believe that any expense that does not exist if a product is not sold, then it should be. If it doesn't exist, if the product shouldn't be showed, it should be a cost of goods. But let me try that again. If it's an expense that is going to happen whether you sell the product or not, it is likely an operating expense. Now, you take your revenue and you subtract your cost of goods. You buy something for $100, you sell it for $200. So you take that $100 out, so 200 minus 100, so you got $100 of gross profit. Now, so your sales revenue minus your cost of goods equals your gross profit. Now, gross profit is reported in two ways. It can be reported as a number, $100, or it could be reported as 50%. So it depends on, and it's actually usually reported in both. Honestly, I'm a percentage guy. I'm looking at the percentage, but ultimately what matters is the dollars.
That'd be gross margin.
What's that?
I think it's called gross margin.
Yeah, well, if you look it up, margin is interchangeable for dollars as well. But a lot of times when somebody's talking about a gross margin, a lot of times they're talking about percentages. But it is margins actually used for both the dollars and the percentage oftentimes. Then you have your operating expense. So now you have, and we're going to go over a financial statement here in just a minute. So you have your $200 that you sold it for, $100 that it cost you, and now you have a gross profit of $100. Now you got to take out your operating expense. And what are those operating expenses? Remember, they're your rent, your payroll, any interest, your utilities, all these other things that are not directly related to that project or to that product. In your case, Mike, a project probably more than anything else. Now, remember, those are the 6,000 accounts. Okay. So now I'm going to subtract those. And then I'm going to either add or subtract any non-operating income. And that would be if you sold a dozer that you owned clear outright and you made $3,000 on it, you'd have to tack it here onto here to get ultimately to get your net profit. So this is where your net profit comes in. And this is how your net profit. Now, there's a little asterisk there because that's net profit before taxes. Okay. That's generally how you and I will operate. We focus on net profit before taxes. One of the reasons is because taxes never hits our statements because it's usually rolled up into our personal statements. So you won't see, you know, a tax on that statement because it rolls up to you. So that's net profit before taxes. So you take your revenue minus your cost of goods equals your gross profit, subtract your operating expense, add or subtract any non-operating income or expense, and you have your net profit. And some people use a 7,000 account. You'll see on mine, I think I might pull something up that has an 8,000 account in there as well. So let's look at a basic income statement, and then we'll sit on it for a second. We'll talk about it a little further. So first, let's say that you have sales revenue of $1.5 million. Now, remember, this is a 4,000 account. All right, then you have your cost of sales. That material that you sold, we're gonna take a widget. Love the widget, so we're gonna have a purple widget. We sold a load of purple widgets for $1.5 million. Those are some expensive widgets. And then we take and we see that the cost of those widgets were $1 million. Now, what can go into the cost of that? It could be the product, the widget themselves. It could be the freight inbound for that widget. It could be all kinds. It could be the import fees for that widget, whatever it is. That's my cost of sales, which is a 5,000, and then that gives me a gross profit of $500,000, 33%. That's an important number. You're always watching that percentage. Now, there's some people in our group that have a very low gross margin because it's more pass-through type business. And then you have some like your gross profit probably is higher than this because half of it depends on where you're putting your direct labor. Half of your cost may be labor. So we'll get into that. Then you have your operating expense. Now, your operating expense, including your rent, your payroll, your utilities, and your banking and all that, your interest that you're paying, all that comes to $300,000. That's a 6,000 account, remember. And then now there's two other 6,000 accounts I'm going to put in here. Now, I broke them out for a reason. You'll see that in a minute. But these normally this would just fall under operating expense, but I broke them out intentionally here. So let's say you have depreciation of your equipment of about $50,000, and you have interest that you paid because you have a loan about $25,000. So your net operating, then you have your non-operating revenue. Let's say you sold something and you made $10,000 off of it, a piece of equipment, and you sold another one and you lost $5,000 off of it. So that would make your net profit $130,000. So all I did was I took that $500,000 and I've subtracted all my operating expense, my depreciation, my interest, and also my non-operating expense and revenue, which gives me $130,000. It's not about what goes in the bank, it's about what stays in the bank. So my net profit on this is 8.6%. Okay, so you notice that I drew a line there. So you see this wonderful little line right here. I did that intentionally because a lot of times when we talk about gross profit, we're talking about above the line. And when we talk about cost of sales, I kind of mentioned it a few times here. Cost of sales is a little bit of a gray area, and different people will put different things in there. Again, my recommendation, as I said earlier, is anything that attributes that if it would have cost you regardless of selling it, then it should be down here. For instance, your payroll for your accountant or for your accounting department. It's going to continue on. So that's an operating expense. But if it's a commission or even if some people, if it's direct labor, they'll put that up here in their cost of goods. It just, when you think about this number, you just got to know what that number is built by, because you might say my net profit is 45%. And he might say, well, mine is 32%. Well, he may be including direct labor. You may not be. So that's where it gets a little iffy when we start looking at gross profit. Any question there, Mike?
I'll ask you the question that my wife always asks me when she looks at this report.
Uh-huh.
Where is it? Where's the money?
Where's the money? That's the nasty thing of a accrual method. It's kind of cruel. You're right. Where is that $130,000? Yeah, go look on your balance sheet. You'll find it there. A discussion for another day, right? The next thing I want to show you is that so we look at gross profit, we look at net profit. A lot of times, people want to know what is their operating profit. So this means that, look, I'm gonna separate out this extra stuff. This where I sold my equipment or where I rented out part of my building, that type. I'm gonna pull that out, move that out of the way. Renting part of your building actually could be up in operations just to counter your rent that you're paying. But anyway, I'm going to move those out of the way. So what was my net operating profit? So your net operating profit here is 8.3% because you don't have that extra income that you got from that non-operating revenue and expense combination. So in this case, it goes down. Sometimes it goes up, sometimes it goes down. But this is really kind of more the accurate number of what somebody's really wanting to know. What is your net operating profit? And again, this is all before taxes. Then you hear the word EBITDA a lot. We're going to talk about EBITDA a little further, but EBITDA, as you can see, I put it above depreciation and interest. Now there's a little A on the end of that, and that A means amortization, and that has a balance sheet. That's a balance sheet number, but we're going to leave that alone for now. But EBITDA is earnings before interest, taxes, and depreciation. So I'm going to pull out my interest. I'm going to pull out my depreciation because see, depreciation is kind of it's a non-cash number. As we'll talk about depreciation, you may have, if you went out and bought $100,000 piece of equipment and you paid cash for it, unfortunately, you can't expense $100,000. Well, there's some accelerated depreciation opportunities and stuff like that. But typically, you don't write that. You can't write that expense off that year. You got to spread it over a period of 5 years. So since depreciation is when somebody's looking at potentially purchasing you, one of the things, or a bank might even look at this, but one of the most important things to them is what is your EBITDA? In this case, you've got an EBITDA of 13.3%. So, you see it's going to be higher than your net operating profit, which is going to be different than your net profit. So EBITDA is an important number if somebody's looking at valuing your company. A lot of times that's how they're doing it. Jim, you got any thoughts on EBITDA in your experience with equity people looking at you and so forth?
Well, yeah, I mean, they do look at that because that's what that's the world they run in. I don't think as a small business operator, you look at that until you think you're going to be selling.
I agree.
Yeah, you just focus on your operating income. Non-operating is usually not relevant. It comes and goes based on other things. Just your operating income, and then you can take it, decide whether you want to put interest back in or not, when you look at your business. But all of this is really a tool. You're gonna have to decide. Like, remember the 3 boxes he said. The one is for reporting. One is for conforming to taxes or paying your taxes, your government stuff.
Tracking performance. Performance, making decisions, and legal.
Right. And so the legal one, your accountant's going to write this up to achieve that. You have to know that you own this. This is your tool, and you design it, and you go into that chart of accounts and you put in what you want in there. And so you decide where some of these things go, up or down, above the line, below the line. And so that's why I always want to make sure you understand this is your tool. And when you think about what you want to see, you know, close your eyes and just say, if I, in a dream world, I would want to know this to run my business. And then you try to capture this on this report. And so that's where you're making decisions and you're reporting for running your business and knowing, having a feel like you have control of your business, knowing the information you need. So that's why I see this as a.
So while we're on that topic about being yours, I'm gonna pull up my P&L, and so you see this one is from January 1st to June 23rd, 2020. I don't know why that. Oh yeah, I don't know why I picked June. Anyway, it doesn't matter because that's not the important thing. So it's a particular period of time. Now remember, I said the 4,000 accounts, the 5,000. See how they fall in? 6,000 accounts, and then down here at the very bottom you'll see a 7,000 account. Now, in your chart of accounts is really important. It's really important because it's how you if you're going to use this as a tool, you need to make sure you're reporting the detail of your transaction or the transaction as detailed as you want to see the data. The more detail you put in, the more detail you can get out. So if you have 2 or 3, let's say, somewhat divisions of operations, and I don't mean full divisions. It may be, it could be product lines, it could be service lines, that type of thing. For instance, if you see here, under my 4,000 account, I actually have sub-accounts. I have my RRT, which is retroreflectivity technologies. I have my safer roads, my alert brands. I have my guideline. And then I have other, because there's sometimes it doesn't fall under one of those. And then in this case, I've got the rental service. So what I have at the very bottom is $1.3 million. But if you look through here, I can go in now because I have these separated. I can go in because I've also, if you notice, I will mirror my expense accounts, my cost of goods accounts with my sales accounts. Because now I can go in and say, how much money am I making on the retroreflectivity stuff? How much am I making on alert brands as far as gross profit? So this gives me an opportunity, and that's why this account structure is important. Now you'll notice something else. You notice that it says 40010, and then it goes 40020. It doesn't go from 410010 to 40011. Okay, this is critical when you're building your chart of accounts. You want to make sure that you leave room. You leave room between your numbers, and that's so that you can put something else. What if I had safer roads and I wanted to break safer roads out a little deeper? And that's what that little XX on the end was. Sometimes you can actually make them, you know, get down into the detail. The problem is kind of as it said in the beginning, that accrual method, any type of accounting method that we're working with this kind of stuff, you can make it as complex as you want. But you better make sure you're able to easily put that data in, and most accounting systems like QuickBooks that we're using now can do that as well. So you can actually have I can pull a report that just tells me how much money I made on safer roads. So putting those proper account numbers are important. Same thing with your expenses. Like 6,000 is my advertising and marketing. Well, I wanted to know, how much am I spending on print? Now, the reason I do this is because I had a marketing department that these were line items that they had to manage. They'd say, okay, I've got in my budget, I've got $10,000 of budget for print. And so they would allocate, when they would pay the bill, they would code it to print so that they could manage and watch that. So again, I'm able here to break this out. Now you notice these numbers even are spread out even further. 602, 604, 606, and you can see them going up, up, and up, and so forth. So the numbers on your chart of accounts can be as little, can be as basic as this, 4,000, 5,000, 6,000, or it can be as detailed as the chart of accounts you saw of mine. It just depends on how much detail you want. But remember, the more detail that you have going in is the more detail that you'll be able to pull out and be able to recognize. Remember, it's about watching performance. You can't watch performance of a specific item unless that specific item is being specifically posted. So very important to understand.
I was going to suggest in QuickBooks, there's a P&L and there's also a summary. And so you can take and bring a lot of detail into this P&L and break out where everything's coming from and going to. And then, but when you want to just have a quick look at what's going on, you hit the summary one and you see all your main categories. And then if you want to go and say, okay, where is that money coming from? What am I selling in that category? Okay, professional fees. How much was that going to lawyers? How much was that going to consultants? How much that was going to accounting? And then then you just get the expanded one, hit that button. And so with just a click of a button in QuickBooks, you can go from, detailed to summary, a high overview pretty quick. So I encourage you to have a very detailed chart of accounts where you can find everything and have a detailed P&L, because you don't have to worry about it being so clustered or so confusing because it's so much, because you just hit your summary report. It's just like you can also hit a button and go back and forth between accrual and cash. So you put it all in as if it's accrual, but if you want to see it as cash, I'm not sure why you would, but depending on your size of your business, it can go back and forth.
Yeah, that's so that's a scrolling or roll up thing. So it's just a button on the side. You basically get a statement like this, and you can click on it and bring it down. It'll give you more detail of that and more detail of that, and you can roll them up and roll them down. So that's true. So you don't have to look at that type of income statement that I showed you a moment ago to get this kind of income statement. So you can look at both. And sometimes that's all you want. You want an overview. What was my sales so far this year? It's $1.5 million. What's my cost of my gross profit? Now, we're going to talk about key metrics a little bit here in just a second, but I want to make sure I go over depreciation again for a moment. But when we start looking at key metrics, you have your key performance indicators, you have key metrics. A key metric is almost always gross profit margin. What kind of gross profit are you running? What kind of margin are you running? And then secondly, of course, is almost always your net profit. And usually net profit, net operating profit is what you're looking for. So those are going to be some key metrics. I'm going to cover depreciation a little bit more just to make sure that we get this. So depreciation is when you take a business asset and it's a systematic allocation of cost of a tangible asset over its useful life. Now, its useful life is usually 5 years. You'll see this. There's not too many rules out there that it's 3 years for this, 5 years for this, 7 years for that. But for instance, I think we depreciate our computers in 3 years though. But I was reading some stuff and everything was talking about 5 years. But anyway, so what you do is it's for buildings, machinery, vehicles, equipment. When these are not typically expensed in its entirety in the year of purchase, instead the cost of the asset is spread over an estimated useful life through the process of depreciation. So again, this is what I was saying earlier. Now I'm going to set aside this thing called accelerated depreciation for a moment, but I'm going to say that typically when you buy a vehicle, now once you buy that vehicle, understand it, whether you get a loan for it or you pay cash for it, you have spent that money technically because you have created a liability, so that there has been a transaction that's made. So you now have spent $60,000 to buy that truck, whether it's a loan or not, doesn't matter. All right. Now, typically, if you bought something for, let's say, $600, well, loan or not, whether it was on your accounts payables or whatever, you could take that in that month or that year or that day or whatever, and you can actually expense it and say, well, you can put it against, when I say expenses, putting against your income. But with a large asset like that, you can't do that. You have to, the government requires you to spread it over a period of time. Something that's not mentioned here is leasehold improvements. Like for instance, if you go in and you decide to redesign your your showroom, that can actually be a depreciated expense. Now, we love depreciation when we're talking to the banks because it makes our financials look better because we didn't expense that $60,000, right? So we look better. So we love it during that. But we don't like it when we do our taxes because that means that we can't take that and knock it against our income. So depreciation is kind of it's a friend and foe at the same time. Now, very quickly, there is I believe I haven't done it in the last couple of years because I haven't bought anything, but there is accelerated depreciation where you can take a portion of, let's say, at one point it was like $125,000 of purchases of asset purchases. You can take that and accelerate that depreciation and expend expense it in 1 year. Even if it was like, if you did 250, you can still only do one up to 125, that type of thing. But typically our stuff is depreciated. Now I'll look at, like, when we were expanding and we were building these locations out, well, I had to buy a lot of racking. And so we had a rule that anything that was over $500 had to be examined to see if it was something that we should depreciate. Now, why did we do that? Well, we really did that so that we wouldn't show the significant losses that we could have shown because we're spending so much money on these openings and so forth. So we kind of looked at that, and also to keep the IRS off our butts. They would rather see you depreciate something than to expense it straight out. So any questions on depreciation or additional thoughts? All right, so let's go to EBITDA. We talked a little bit about EBITDA. EBITDA stands for earnings before interest, taxes, depreciation, amortization. It's a financial metric that's commonly used to evaluate the operating performance and profitability of a company. As Jim was saying, is that this is not something that it's not something that a typical small business owner looks at, except when he's thinking of, so I'm gonna take that back. We should almost always be thinking of our exit. When I was in Entrepreneurs Organization, that was like rule number one. When you start a business, you should already have an exit strategy the day you start your business. Okay. What are you going to do to get out? Okay. So that was kind of holding the hill and the kingdom thing. That changes that a little bit. But the concept is that if you're building a business to exit, if you're building a business to eventually sell that business, then there's nothing wrong with looking and managing your EBITDA from day one. Okay, so that's the EBITDA is important because that's how your company is valued by others. In most cases, there's all kinds of ways they look at things, but EBITDA is the most standard. That's what you'll hear. It's multiplier times the EBITDA. EBITDA represents the company's earnings and profits before deducting the expenses of interest, taxes, depreciation, and amortization. By excluding these specific expenses, EBITDA provides a clear picture of the company's operating profitability and the ability to generate cash flow from its core operations. Let me give you another reason that depreciation and interest are not normally in the EBITDA, because when the transaction takes place, usually it's a larger organization that will probably finance themselves. And so, and the depreciation is something that they'll go through their CapEx program with. So being that it doesn't really matter to them as far as what you're paying in depreciation and what you're paying. And your taxes, that doesn't matter to them either, because their tax structure is going to be totally different than yours. So that's why one of the reasons they kick those three out. Amortization has to do with the value, how much money you've put in that company, and then depreciated that intangible or that stock or whatever it is out. It's actually, it was minor for me. I think I was amortized out by like year two or something. I think I had $150 that I started a business with or something. So, but anyway, so that's your EBITDA. Any questions on that? All right, we're going to go to KPIs. Now, we're going to kind of dig in a little bit here, but I want to talk a little bit about KPIs, key performance indicators. This is a company that should use to depend on its specific industry and goals and strategies. So you want to, everybody has their own. Now, I separate key performance indicators from key metrics. To me, key metrics is more of a higher level, less, they're still specific, but it's like your gross margin or your net margin, or it could be some other things. Well, actually, I'm going to show you here. So it's important to note that the selection of KPIs should align with the company's overall objectives and strategy. It's advisable to choose a balanced mix of KPIs to provide a comprehensive view of the company's performance across various areas. Additionally, KPIs should be specific, measurable, achievable, relevant, and time-bound. Remember that one, SMART, to effectively track the process and improvement. So there really are 5 areas that we look at, and we're not going to dig in these, but 5 areas that you look at for KPIs. You can look at your sales and marketing, your organizational efficiencies, your customer service satisfaction, like NPS. We talked about NPS before. Operational efficiency is could be your inventory turnover, super important if you're selling product. Your sales and marketing KPIs would be your lifetime value of your customer, what your customer acquisition cost is, those type of things. And then your employee performance and engagement. And these could be how many hours each of your employees are being trained, and what their absenteeism rate is, and so forth. But the big one that we're really here and we're going to talk more into is this KPIs, the financial KPIs. And this has to do with profit margin, revenue growth. It could be your return on investment. It can be your cost per acquisition. This has to do with acquisition of customers, or even a product market, or a market in general. So, Jim, I'd kind of like to lean on you a little bit on, and even maybe Brett, a little bit on the KPI side, as to, let's talk about if you have the financial statement in front of you, how can you use this data that you have? How have you used this data that you have? And I'll pull up my other there you go. All right. How do you use this? What do you use? What KPIs can you pull off of your profit and loss statement, or your financial or your income statement? Any thoughts?
Go ahead, Brett.
Well, a lot of things are based off. So you can do like general administrative expenses as compared to gross revenue. Mm-hmm. You can do basically a lot of the KPIs on the income statement can be in regards to gross revenue. Then that way you're comparing apples to apples among your KPIs. So because your gross margin, your net margin, all flow from as they relate to gross revenue. And
I like that. I like monitoring your operating expense percentage over your revenues. Yeah. Because that will tell you, okay, for every 1 million, or let's say every $1,000 that I purchase, or I mean that I sell, it's costing me $3, or it's costing me $30, or it's costing me $300 to operate the company. Yeah. And this is where I get jealous, because I see some of these companies that are turning significant revenue off of very little overhead, by very little operating expense. Now, usually, if that's the case, guess what? It balances out, right? Because their gross margin is a lot less. But you see some companies that can have 3 people on board and do 10 million, and you see some companies that have 50 people on board and they're doing 1 million. And so yeah, operating. I like that. That's a great KPI to look at. Is your operating percentage of your operating cost to your revenue.
And I think you can even do your labor dollars per gross revenue as well, and drill even down a little bit further by category.
Love that too. Love that too, because a lot of times that'll show you either process efficiency, equipment efficiency. If your guys are spending all their time working on your dozer because it keeps breaking down, you can find out real quick. You see those dollars or that percentage too high, and you say, okay, how do I cut that? Because if I can cut that percentage down, it's going to go straight to my bottom line at this point. So a great thing to look at is your labor cost per dollar of sales. Mike, what's your thought there?
No, it also doing it that way helps you understand your break-even points and sales per month. When I understand if my operation expenses are pretty steady across the board, then I know where my break-even point is in sales, what I need to do to start generating that profit, and then increasing the sales past that break-even point is where profit really starts to get driven in Earthscape. So knowing that number's good, and really that's when our sales hit that number, everything else past there, the profit margin just changes dramatically.
It does.
And about 2 or 3 years ago, you started focusing on that, and ever since you started focusing on that, it's been kind of up and to the right.
Yeah, absolutely. What about you, Jim? Anything else you think about pulling out that you're able to take these numbers and create a KPI out of it?
Yeah, again, I would invite or encourage each person to do somewhat of a brainstorm on what do you want to know about your business, and just start writing everything on a whiteboard or a big tablet, and just start, you and your staff, saying, well, what do you want to know? What do we know? We need to know what's success, what's failure, what's the problem, how do we catch this early, how do we catch that, and write everything up. And then you look at them, you'll have a whole bunch more than you're going to track, and then you'll see that quite a few of them consolidate. You can bring them down to a certain number, catches 2 or 3, and then you'll figure out what you need to manage your business. And so I would start with that kind of process. Greg, I'll share my screen. All right, so again, it's a P&L: sales, net sales, labor, gross profit, operating expenses, and net profit. But this is where you can see, like that other one, most P&Ls, you see your month. This column here, you see that actuals for your month, and that's all you get. Well, what you'd probably like to know is, well, how does that compare to the same month? So if this is for May, how did that compare to May of last year? Or if you want to compare it to the month prior, you could say, instead of prior year, you go with prior month. So anyway, you want to see your numbers. And if you do a projection or a budget, you want to know how you're doing compared to your budget or your projection, and how last year. So this gives you a picture pretty quickly of how you're doing on that. But a lot of numbers vary. For example, Mike, you do a big job, and that 1 month looks pretty good. But the month after or before looked pretty bad because you were throwing all your labor in the other job. And so sometimes a 3-month run smooths it out and gives you a more accurate picture of what's going on, especially if you have a 5-week payroll month and comparing it to 4-weekers, that's always a problem. But in a 3-month run, you always have 1 5-weeker and 2 4-weekers. And so this makes them, when you compare that 3-month run to your projected and to your prior year, it starts to tell you something fairly interesting. And then, of course, you can look at the 12-month one here too. Anyway, you see it's actual projected in prior year also. And so those are numbers, dollars, and you probably want to put them in like a K, just a thousands, maybe up to 10,000, depending on how many dollars you're running. You don't need to see $38.62. Because remember, this is a tool you're using to manage, not just report taxes. So then you go to the next one. This is when it's a percentage of sales. And so you're looking at, I said net sales. And here's my one push in business is, it's not, sales is revenue, right? Or revenue is vanity, and profit is sanity, and cash is king. Well, just under sales, as much as that's odd or out of line, distortion, net sales is better. That's what, after your direct cost of, say, your subs and your material. So again, Mike, you're doing a job and you got a bunch of pavers and you got some subcontractors. Well, all you did was pass money through to them. What did you get to keep? What were Earthscape dollars? Those are net sales. And what did you do with them? And so I would run my reports as a percentage of net sales. So when you look at your P&L, you're going to have a net sales number. If you set your P&L up for that, you use that number here. And this is just a spreadsheet, so your bookkeeper can put this together pretty quickly. I can send you the template if you want, but basically they can just fill in the data pretty quickly. And then I don't know if you remember or know that in a spreadsheet you have a place to put a comment. And so let's say you made a lot of money one month, you might want to put a comment in that month that says paid in advance client, or damage to somebody's house. Because sometimes when you want to look back in your numbers, you can't remember all this stuff. But if it's on this thing where it goes every month, you can look back and say, oh, what's the comment on that? What's the note on there?
So are you
performance indicators?
good?
Sorry.
Good.
So then we get to the key performance indicators, and this is where you start putting in your stuff that these are financial ones. These are not your operating ones. So like in EOS, you're going to have your scorecard and everybody has their numbers. Those aren't these. Those are a different set of numbers that are more specific to what everybody's doing. But when you look at your receivables, you don't care how big they are. You want to know how big they are over 30 days or 15, depending on your collections process, maybe 45. So it's some number. You might want to know your sales pipeline. How much is it now? What did you project it to be? What was it prior year? What is it projected for the next 3 months? Where are you on that? And for the year? And you might want to know what kind of cash you have in terms of operating days. You look at your operating costs and you want to know how many days of operating cash you have. And the net sales per hour. Now this is where hours are not on your P&L. And QuickBooks does not connect hours with financial. It's the weirdest thing. But you just have to go look at your hours and you divide your net sales by your hour. And that shows you how well you're doing compared to how you're bidding. So if you're bidding $50 an hour, are you making $50 an hour? You should have that number so you don't fool yourself thinking you're doing great because you're making profit. And so you're bidding one number, you should see whether you should have good feedback on that. And you don't have to do it on every job necessarily. So those are just a few that sort of pop up in my mind of some KPIs.
Yeah. So something go up to the top there. So one thing that I've learned over my career is that it's really difficult to go month to month, to look at your one month versus the next month versus the next month, even month of year one versus year two versus year three. And I used to look at that a lot, and it'll drive you insane because you'll be way up, you'll be way down. But I have found that the most consistency that I can find is quarters, and that's just 3 months. You should be monitoring your monthly by all means. But when you start doing a comparative analysis, on your financial statements, my suggestion is never do less than a quarter. Because there are those ups and downs, as Jim was saying. You're going to have a big sale in 1 month. Well, if you have a big sale within 3 months, you probably had a big sale within the 3 months previous to that. So I watch. I think it's important that as you look over and watch your numbers, that you're looking at a quarterly versus looking at a month, and as far as comparative goes, looking at quarterly over monthly. I also there may be 3 month cycles that are odd to your quarter. So you may, like for instance, our slow months are December, January, February, not January, February, March, because March starts to pick up. So you may decide that your quarter is different as far as for your reporting purpose and for your tracking purposes. You may decide that 3 months may be something a little bit different. We always found, for instance, April and May, January, February, March, April, May, June. Yeah. So our big months were our big months were April or May and October or November. And so so October, November, December, both of those were in the same quarter. April and May are in the same fiscal quarter as far as calendar fiscal year. So we were okay there. But if we had our biggest months was either February, March or April, then we could really throw our quarters off. So we would have probably adjusted how we manage that. Another thing I would say is that don't forget QuickBooks does. I'm looking right here at a report. It's a monthly report that does a comparison of my financials, and I can look across there. I'm going to guess I can pull a chart on this. I don't at this time, so I don't see it, but it's probably there. So QuickBooks will give you those comparisons. So again, big thing, not month after. Don't compare your month to this same month last year. I recommend against that unless you have a real stable business. But if you're in construction contracting, you could have a rainy month. You could have all kinds of things going on that's going to throw that off.
Hey, Jim.
Yeah.
In your spreadsheet here, is that a rolling 3-month, 12-month, or is it fixed?
I would use it as rolling, but you can choose however you want. You can make it seasonal.
You
can make it quarterly.
Crabtree and Simple Numbers, he advocates for the rolling.
Yes, I'm a big rolling numbers as well. I like rolling dates rather than, because that gives you, especially if you do an annual.
Yeah.
If you do an annual, now you could be on the cusp of a big month. That April and May, for example, there could be an issue. But I've already picked up May of last year, but maybe the big month was in April. So, but rolling is, for me, has always been more beneficial to manage by a rolling year rather than a calendar year. It's been very helpful.
Yeah.
I've got something else here. Let's see. I was wanting to talk about, we're at 15 minutes here and we'll be done. I wanted to talk a little bit about lowest lows. I think I mentioned this in one of our groups, is that
I'm going to stop sharing so you can take over.
Okay. Yeah. So as you're tracking your sales, and you're watching your sales are obviously you're going to have highs, you're going to have lows, you're going to have highs, you're going to have lows. Again, maybe the spread is not as great depending on what industry you're in. But one of the things that I learned several years ago, I had a guy teach me this. He said he was looking at our financials over like a 5-year period, and what he saw, and it kind of frustrated because I see this spike and boom drops down, spike and boom drops down, and so I'm like, I can't tell, are we doing better or not? And sure, year over year, yeah, we've got more sales, but that didn't really tell me the whole picture. And he said, Greg, this is what you got to watch for. Are your lowest lows getting lower or are they getting higher? In other words, as you see those dips, are they dipping below the lowest dip before? Are they, and is that consistent? And what he saw was we never, for like a 3-year period, our lowest lows were never as low as the recent lowest low. So we were always, even our lowest number was still higher than our lowest number previously. So watching your financials and looking for that lowest low is a great way to examine it because of the fluctuation of business. And I wanted to share that. That was something that was taught to me that now I look at and try to manage from. What's that? Is that yeah, there. I'd like to have that. Yeah. Yeah. But now if you just zoomed in to that top part, to just a couple of those points, it'd be hard to tell if you were doing any better.
So what that does is that's like a 3-year one, and then you just keep adding the last 12 months, and you just keep adding, and it just keeps rolling along. And so you take off last February, put on this February. If your spikes ups and down are in generally where you're replacing 1 month with a better month, and then 1 month with a better month all the time, you're going to see it climb. And if you aren't, you're going to see it dip, and you'll see that trend like immediately with that trailing 12-month chart.
Right. All right. Well, any thoughts or questions? Anything that maybe we didn't answer that we can answer from either Brantley or Mike? Again, this was mostly to be a kind of a good basic get you started type thing. Hopefully it did that.
Yeah, I have a question.
Yeah.
So, when we were talking about doing our assets, assets, I don't have any assets that are over $100,000, so
Okay.
I'm not dealing with those types of expenses. But I do have assets like this microscope right here. It costs me about $5,000,
Yes.
and I use it for work every day.
Yep.
And it's going to last me 25 years. It's
Right.
just a really solid microscope. But the question is, I'm sure the IRS doesn't really care so much if I spread that over 4 years, but is there any benefit to me, or should I just, call it an expense for this year because I'll probably buy something $5,000 next year?
Okay, so here's my non-accountant response to that. First of all, you should depreciate it because of the value of it, and they'll have you depreciate that at probably at 5 years. Now, there's the technical way is that you take the product's value, and then you basically say what is its salvage value. In other words, if it was completely depreciated, what would it be worth? And then you subtract that and you say, okay, the difference is what I'm going to and really the salvage value is important because if you do sell that and you've depreciated it to zero and then you sell it for $1,000, you're going to have to claim that $1,000 as income. You're going to have to pay taxes on it. So just something to keep in mind. But if I were giving you, if my advice is that you do depreciate that. Now that's going to make your financials look better. And look better, feel better, that kind of thing. But you may find that through your tax that because it's $5,000, because you don't have a lot of assets, that like when we had a pretty high capex. We had to buy a lot of equipment, especially in our expansion days. And so we would max out that accelerated depreciation number very quickly. And so we had some of it was accelerated and some of it wasn't. And accelerated just means I expense the entire thing. Your accountant's probably going to say, we're going to, even though it's a depreciable asset, we're going to go ahead and fully depreciate it in year 1. Now, I have found that causes a bit of complexities because my internal books don't exactly match my IRS books because of this accelerated depreciation thing. But that all sounds complex. Basically, I would say that and they won't, even though it'll last 25 years, they're gonna depreciate it probably 5 years. I mean, they do say technically the life of the life of the instrument or equipment, but they're not going to do more than 5 years on it. So I would do that, and it'd make your financials look better, and that could be better for your bank if you have to go and get some money. That's just that's $5,000 less expense that they're going to see against your income. If $4,000 less than what because you're going to depreciate $1,000 probably right off the bat.
Got it. Okay. Yeah, it's funny that this meeting came at the right time because I just bought a good amount of equipment and stuff like this, and I thought I see the benefit if I needed to borrow money, but my company doesn't borrow any money. Everything is cash, and then at the same time, we don't have pretty much like, let's say if I thought maybe having a bunch of assets will help the value of the company too when I eventually want to sell it. But at the same time, right now I only have like $50,000 worth of equipment. It's just me and 2 other people. And if I sold the company, I don't want them taking my microscope anyway. So, I don't see super like a lot of benefits for it other than looking like I'm making more but having to pay more taxes for it.
Well, remember in the very beginning, I'm not sure you were there at the beginning where we talked about legal requirements.
Yeah.
IRS is going to frown on a $5,000 purchase of a piece of equipment without you depreciate. So your accountant should be able to give you guidance on that, but they're going to by their rule, you're going to have to depreciate that. But again, they may just accelerate that depreciation. Mike, what do you got? What do you got there, Mike?
We had a lot of equipment and we depreciated it aggressively during years that we weren't profitable. So we had nice refunds. The next year when we were profitable, I really wish that I'd spread that out a little bit further. So another thing to keep in mind, if you're seeing a growth plan of, hey, I know this year is going to be, you know, we're gonna have a break even year because of just expenses, things like that. But next year you're really planning on growing, having profit. It's nice to spread some of that depreciation out. It doesn't seem like huge numbers, but still, when you end up paying 30,000 instead of getting 10, it's a little bit of a hit that you're not expecting. So we depreciated all of our big assets very quickly, and it bit us. It was great for that year, but looking down the road a few years, just if you have a little bit of a plan of where you want to be, that might be something to put it in balance with as well.
Oh, Mike, you're going to get to where $30,000 in tax pay is nothing.
If
Right?
you're paying taxes, you're making money, right?
The plan is $1 million in taxes a year.
Crabtree says that's the best KPI you can have.
Yeah. How much taxes am I having to pay? One of the things, but in dollars, not in percentage. All right, guys. Well, we are out of time, and again, I hope that this did some good. And if you have any more questions, any of the three of us, Brett, I think, don't you have like an accounting degree or something? Mm-hmm. Yeah, that's what I was afraid of. And Jim and I are the practical guys. We know a lot about it because we've worked with it for, I think, both of us for over 30 years.
Just so you guys know, there's two types of accountants. There's the guys that do bookkeeping and accounting, and like a firm, they just process bean counters. And then there's people that are like finance people. And that's what Brett is, where these guys are actually in businesses doing the bookkeeping and accounting and kind of stuff. And they have a much better picture of the numbers meaning something in the business. Mm-hmm. So whenever you talk to people, when they say, oh yeah, I'm an accountant, recognize you need to figure out which one you're talking to, because they can be very different.